And there's the obvious question now as well to consider of how to go public, whether a traditional IPO is the right answer or direct listings. I mean, Spotify and Slack and who knows who's going to be the next. Your view on that. Is that now going to be more of the norm than the exception? Or?
Yeah, well, I've actually been digging into this quite deeply ever since Barry McCarthy led the way with the Spotify direct listing. And I apologize to the Silicon Valley community that it took me 2 decades to figure this out. But I think Silicon Valley's been on the bad end of a bad joke for about 4 decades now in terms of the way the traditional IPO process works. Barry McCarthy has called it moronic. And the more I've studied and contrasted with direct listing, the more I realize that. I've brought along some data. I don't know if you can show it. This data is compiled by Jay Ritter. You guys have had him on. He's a professor at the University of Florida known as Mr. IPO, and he has tons of IPO data. So the first slide is about underpricing. And this is solely looking at the difference between the price that the stock's handed out to the night before and the close the next day. And so over 39 years, that's been $171 billion for Silicon Valley companies. And it's been increasing lately. Just year to date, we're at $6 billion in underpricing. And if you study the way it works, it's kind of tautological that it happens. The next slide's even more surprising. So the next slide, I asked Jay if he had ever run an analysis of looking at underpricing by lead underwriter. And he said, sure, that's easy to do, and he ran some numbers. So this is 10 years of data, a decade of data, over 100 IPOs per underwriter. And what you see is astonishing. What you see is that no one questions who the 2 best investment banks are. So it turns out that if you go with the best investment bank, you get the worst execution. And that's remarkably odd. If you're Amazon buying cardboard or GM buying steel, do you get the best execution or the worst execution, right? That's pretty understandable, right? You get the best. Here, if you choose to work with the top underwriter, you get the worst execution. So something's not right. There's a market inefficiency afoot.
Wouldn't it be nice, though, for a company like Slack to have that support, and some of these companies to have the support at time of going public?
What do you mean by support?
You know what I mean, from the underwriters.
What support do they provide? The word underwriter is a myth anyway. Exactly. They don't put any capital up.
Right.
The only capital that's available for stabilization is the green shoe, which is the company's own capital. And once it breaks, they make a profit on that. So they're more worried about profit maximization than actually stock stabilization.
But I didn't realize you were that much of an evangelist for direct listings now. I mean, that's...
Absolutely. Listen, when they run a traditional IPO process, you have to understand what happens. They go meet with wonderful people like Brett and many others. So they do like 2 or 3 weeks on the road, and they ask them to give them their demand. And they tabulate it, and they put it all in a file, which would make you think that somehow there's some type of process here. But then guess what? And if you have any of them on, ask them what the target over allocation is for a standard IPO, because they'll tell you 20x. So 20x over supply is a euphemism for we're about to ignore 95% of the demand for your stock. Intentionally ignore 95% of the demand for your stock. Now, in a direct listing process, they match supply and demand. Most people don't know this. They use the standard opening process and technology that's used to open every stock every single day. And one of the ultimate ironies is if you do a traditional IPO, you do a direct listing the next morning. It's just the only people allowed to sell are the ones you handed the stock to the night before. And that's why this is set up to fail on behalf. Now, I kept studying that list of the lead underwriters and wondering how could that possibly be true that the best players give you the worst execution. And it dawned on me. There's an area of study in economics called the agency problem, and there's the variant of it called the multiple agency problem. So you've got an agent who's looking after multiple parties, the company, but guess what? Also the buy side. Now, if you look back at that chart and you say, what if their job is to pass along the most profits they possibly can to the buy side, then the chart makes sense. So you just have to realize the customer is not the startup. The customer is the buy side.
So Bill's thought about this.
A little bit.
We've talked about this.
Are you as passionate?
We've talked about this. And we're huge supporters of a really tough scrutinizing process by the company to evaluate direct listing versus doing an IPO. If you need to raise primary capital for the business, it may work out better that you do an initial public offering. But I will say this. The one thing I'm absolutely certain of is the spotlight that Bill is shining on this, that we're shining on this, and many others in the ecosystem are shining on it, is going to close the gap. The days of handing low-priced securities, diluting a company to a bunch of long-only shops in Boston and New York, I think those days
It's
are
not
over.
a bunch. I think it's a tiny handful.
And so, like, I think that at a minimum, this will go a long way in educating an ecosystem about an alternative. The alternative is real. An algorithmic approach makes more sense than doing this on a spreadsheet and hand allocating it out. And so we're very supportive of it. Where we are on audit committees, on boards of directors, we're requiring the company to consider this as an alternative.
By the way, Chairman Clayton, in his speech yesterday at lunch, talked about fairness and access, and that's another thing here. If you are in a direct listing, any direct listing, and you are at a Schwab account, a Robinhood account, I don't care what, and you put in an order that's a penny higher than the closing price, you get filled. That is not true in a traditional IPO. In fact, retail's often held to 5%, and you have no guarantee that you can get access. So the people that are getting that cheap stock, that $171 billion of value transfer, is a handful of the best accounts of the best clients.
But let me answer one question that I know the Twitter feed is blowing up with right now, which is, yeah, but Bill, Slack is down from 38 to 24, so doesn't that mean that the direct listing model doesn't work? This is about the dilution suffered by a company on the day that it lists. How a company performs 3 months, 6 months, 10 years down the line has to do with the fundamentals of that business, has nothing to do with whether they do an IPO or direct listing.
I totally agree.